Hi, I'm Shannon, Seery, an economist with Wells Fargo, and we're joined today by our chief economist, Bryson, to discuss the latest changes to our forecast. So the economy remained quite resilient through the first half of the year. Since our last monthly update, we got second quarter GDP growth, which showed the economy expanded at a 2.4% annualized pace. If you consider the economy's potential growth rate somewhere between 1.8 and 2%, this means we were growing above potential. The labor market also remains tight. We have seen a moderation in job growth, but with employers adding over 200,000 jobs a month, we're still running at a pace that's above pre-pandemic levels. And at the same time, inflation is continuing to moderate. So consumer price data through July does show that the annual rate of inflation is still running about 2 times the Fed's target, but the 3-month annualized pace has slowed to the lowest in September of 2021 at about a 3.1% annualized pace. So with that backdrop, Jay, of a resilient economy, how has our outlook evolved over the past month?
Well, so Shannon, we've had a modest recession in our forecast for quite some time, and we still have that, call it modest recession, in the forecast. So let's just level set. What do we mean by modest? So if you want to measure it by GDP, the peak to trough decline in real GDP in our forecast is about 0.5%, and I know that doesn't probably mean anything to anybody. So let's put that into terms or in comparison. If you look back to the aftermath of the financial crisis, the economy contracted 4%. So if we're talking 0.5%, that's relatively modest. And as downturns go, that's pretty small. Another way to look at it would be through the unemployment rate. Right now, the unemployment rate in the country is roughly 3.5%. By early next year, we think that rises up to, let's call it 4.5%. That's a change of 1 percentage point. And again, just to put that into perspective, if you look at the financial crisis, we went from 4.5 to 10. That's a delta of 5.5 percentage points. So in general, this downturn that we have starting early next year, is still relatively modest.
Right. So how do we get to this recessionary period, right? We see the economy has remained resilient through the first half of the year. What do we see the catalyst for a recession?
Yeah, that's a great question. And so if you think about the most recent recession we had, the pandemic, I mean, that obviously what was the catalyst there was the shutting down of the economy. This is a little bit more, I'll call it benign. So you talked a little bit, about the Fed there. We think the Fed is done at this point in terms of raising rates. Now, could they bump up another 25 basis points? Sure, right? But at this point, they've raised rates by 525 basis points. And so we don't think they're going to be raising rates significantly, but we don't think they're going to be cutting rates significantly. You talked a little bit about inflation. We're not back to the Fed's target at this point, and we don't think the Fed's going to really start cutting rates until they're convinced we're moving back there. And so I think what will happen as we go forward is, the Fed's going to keep the nominal Fed funds rate where it is. As inflation recedes, what happens is the real Fed funds rate, the nominal rate minus the inflation rate, is going to rise. And that's the real Fed funds rate is what really matters at the end of the day for real GDP growth. And so as the real Fed funds rate is rising, you're going to get a passive tightening still of monetary policy, and we just think it's going to be overdone. The economy, you talked about earlier, running above the potential growth rate. The economy is operating above potential right now. In order to wring inflation out of the economy, you've got to have a few quarters of sub-trend growth. And that's a really tricky thing to do when all you have is the blunt instrument of interest rate hikes. And so it's not like the Fed's trying to put us into recession. We just think that given the lags of monetary policy, given the uncertainty that's out there, it's going to bring about this, let's call it modest downturn.
Right, and I think the talk of soft landing has increased, right? I think it's still possible, but where do you put the probability today of a soft landing where we do avoid or skirt this recessionary period? Yeah,
so I mean, I guess the way I would think about it is, we've been talking about it is, we still think that a modest downturn is more likely than not. What sort of probability? That's a little bit difficult to estimate, but if forced to do so, I would say probability of a modest downturn, let's call it 60%. Probability of a soft landing, 40%, right? So, I mean, the Fed potentially could pull it off, and so far, again, they've been raising rates, and we're not in a recession at this point. I guess what I would say is at the end of the day, not to get too cute about our forecast or anything like that, even if we don't have what amounts to a recession next year, I think you're going to be looking at an economy that is going to have subpar growth. The Fed, again, we're operating above potential in order to get inflation out of the economy, and the Fed seems determined to be able to do that or want to do that. In order to get it out, you've got to, again, slow growth. And so, assuming the Fed remains, determined to get inflation out, I think you're looking at a 2024 for most businesses would characterize it as still, call it challenging, even if it's not a technical recession.
Well, Jay, thanks for joining me today.
Thank you.
And from all of us at Wells Fargo, thanks for tuning in to our latest monthly economic outlook.